Holy smokes, everyone. Wall Street has a dire warning for the banks as credit card debt and the loans they're issuing go horribly wrong. So in today's video, we're going to break down exactly what this means for the banks, some new things they're warning us about the economy, and how bad things are really going to get. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. Wall Street warns of trouble brewing in auto loans as prices drop. Now, this is exactly what I've been trying to warn people about. I've been doing videos about how the used car prices are crashing and how this is going to be losses on the bank's balance sheet, because a lot of these banks, they gave these record loans to people when car prices were at record highs. Well, now these car prices are crashing and these loans are underwater. And this could lead to jingle mail again, with people giving back the keys, because some people even got loans of 100 to 140% of the car's value. And this is going to be big losses for the banks, and this is why they're setting away record amount of cash to prepare for this. The largest US banks are warning of trouble ahead in auto loans as dropping prices for used car risk leaving borrowers underwater. Wells Fargo and Co. said that the higher loss rates for loans it originated late last year contributed to an increase in write-offs for the period. Ally Financial Inc., the country's second largest auto loan lender, saw charge-offs for retail auto loans quadruple in the third quarter. And fifth, Third Bancorp said it's pulling back on originations. So what this means is, everybody, banks are already taking big losses, and they're worried if used car prices keep dropping, they're going to face even bigger losses soon. Used car prices slumped 7% in the third quarter, the worst decline since the depths of the global financial crisis. Wow, everyone. I don't know about you, but it seems like every single day I'm reporting on situations that are happening in the economy with the banks. It is as bad or as worse than the global financial crisis. And yes, while the markets may be green for a week or two, it does not mean things are all okay with the financial system and with the economy, because it can be a lot of volatility in the markets, there can be a lot of noise, but you have to follow the long-term trend, and the long-term trend is your friend. According to data compiled by vehicle auction company Manheim, the risk investors fear is that if consumers end up owing more than their cars are worth, they might stop making payments and let their vehicles be repossessed. And look at this chart, everyone. We can see here, we saw an unprecedented run up in used car prices. But again, people, like all bubbles, they burst. And this is going to be one of the biggest used car bubble bursts we've ever seen. Because you'd literally see used cars, say 5 years old with 100,000 miles on them, selling more than the price of a new car. This is completely unsustainable. And say, for example, if people are behind on their car payments and then they realize their car is only worth half as much as a loan, they may just simply let it get repossessed. There's been a real tightening in margins on new loan production on one hand, and on the other, there's been a decline in used car prices, causes to throttle a bit back on production of loans. And with interest rates set to only go higher, things are going to keep getting worse. When Wells Fargo first started to see signs of high loss rates on loans it originated just last year, the firm moved fast to tighten underwriting standards. The changes, combined with the impact of continued supply chain constraints, caused used loan origination volumes to plummet 40% in the third quarter from a year earlier. And if these losses on these loan originations keep getting worse, we may see a full-on credit squeeze in the auto sector altogether, as banks fear customers may not be able to pay them back as the cost of living keeps getting worse and worse, and people keep getting more and more behind on their bills. And we'll get into in a moment what's happening to people's credit cards. Used car prices jumped during the early days of COVID, forcing borrowers who bought then to pay more and take on bigger loans for their vehicles. Those customers are now reevaluating whether it's worth remaining current on their payments, something that could prove challenging for the auto finance sector. And this is something we saw during the 2008 subprime mortgage crisis. Home values dropped so steep that they simply just gave the keys back to the banks, especially if their credit was already bad in the first place. Now, this on its own may not seem that bad, but we also have more banks warning that a painful recession is going to be coming, and a recession, or more likely a depression, combined with record amounts of debt, combined with delinquencies, combined with defaults, it is a recipe for disaster. Look at this, everyone. JP Morgan president says a recession may be the price to pay to beat inflation. The market bottom is not in yet. And yes, he's exactly right there. The only way we're going to stop inflation is by pain in the economy. There's going to be a hard landing, no soft landing here. And JP Morgan president Daniel Pinto, he actually grew up in Argentina. So he saw how devastating hyperinflation can be, or high inflation. He saw people having to change the prices every hour at the store. He saw people rushing after they got paid to cash their check. Their money would lose more and more value. While there is a growing chorus of voices who say that the Federal Reserve should slow or hold its rate increases, JP Morgan President Daniel Pinto is not in that camp. I think putting inflation back in a box is very important, he said. If it causes a slightly deeper recession for a period of time, that is the price we have to pay. And he also says, I don't think we've seen the bottom in the market yet. He said, adding that corporate earnings expectations were still too high. So he's exactly right there. There is no reason whatsoever for the Federal Reserve to U-turn. The only reason why they're giving these hints is because they're very worried about the bond market. But unemployment is still at record lows, inflation is still at record highs, and company earnings are still holding up. So this should give all the ammunition the Federal Reserve needs to keep hiking interest rates. But unfortunately, that's going to have a big effect on all markets and especially debt markets. And this is starting to have a big effect on credit cards and specifically the cost of living crisis that the people in the US are facing, but not just in the US, Australia, Europe as well. And borrowers are starting to get desperate, but it's just going to lead to more pain down the road. Look at this, more debt, higher fees. Credit card borrowers face mounting burdens. After the pandemic, Americans are borrowing heavily again to keep up with decade-high inflation on essentials such as food, gas, and housing. Credit card debt is rising at its fastest clip in more than 20 years, according to the Federal Reserve Bank of New York. Overall, Americans owe $887 billion on their credit cards, a 13% increase from a year ago. You know what's funny with a lot of these analysts on Wall Street? They're taking this as a bullish thing. They're saying, look, credit card debt's going up. That means the consumer's strong. That means they want to go out there and spend. That means things are great. Well, like it says here, no, the real reason credit card debt is skyrocketing is because it's now a luxury to be able to fill your car up with gas, to be able to have a roof over your head in many cities, and to have good quality groceries. Now, with the Fed rapidly raising rates to contain inflation, families are feeling the pinch of higher borrowing costs. Average credit card rates are at 18.7%, and they're at the highest levels in 30 years and will probably continue to rise according to Bankrate. So that is crazy run. People are paying 18.7% on their credit card debt right now. Now if you're watching, if you have any credit card debt, I would suggest you pay that off as fast as you can and don't even think about investing in the markets until you pay your credit card debt off. Because look at that, 18%. If you can pay that off, that's a guaranteed 18% return. And you know, in the markets, there's no guarantees. A good year is 10%, so it'll be the best thing you could do is get that credit card debt knocked off. But unfortunately for many people, they can't make that choice. The result for many is a sense of snowballing despair as debt loads and interest rates spike at the same time. Credit card debt is risky in itself, and the people who are being pushed to take on more credit card debt as the economy slows are people who don't have other good options. And look at this chart here, people. We can see here from January 1st, 2021, when inflation started to rise, we're starting to see credit card debt skyrocket again. A number of worrisome economic wildcards also remain. Widespread job losses, for example, could mean that even borrowers who have so far been able to keep up with monthly payments may quickly fall behind. And that is a huge risk, everyone. Right now, the job market is holding up, and that's why we haven't seen company earnings take a hit, and while the banks haven't taken huge losses yet. But once unemployment starts to tick up, that's when the real pain is going to begin. Experts say that could lead to a spat of personal bankruptcy filings that could depress consumer spending and deepen a recession. The worry is what's going to happen 2 years from now if people aren't able to pay this debt. Bankruptcy filings were low during the pandemic, but there is a real concern that could change, which has potential to be a really serious problem. And the reason why bankruptcies and delinquencies has been so low over the past 2 years is because the bank just gave everyone pretty much a free ride for the past 2 years. They said, don't worry about paying your mortgage. The government forced landlords to let tenants not have to pay their rent. They said, don't worry about paying your credit cards, your auto loan, your student loan. It was free money for all. Well, people are starting to pay it back now with higher prices and higher inflation. And eventually the party does come to an end. Eventually we do get to the end of the road and it's time to pay the bill. There are also signs that people are increasingly falling behind. The share of borrowers who are at least 30 days behind on their credit card payments has grown to 4.8% from 4.4% a year ago. And Americans with credit card debt are taking longer to pay it off. 60% of those with balances have carried them for at least a year, up from 50% a year ago. So this is another worrying trend here, people. People are becoming more late with their payments and are taking much longer to pay them off. And why this is such a big thing is because then people can get in debt traps, especially with interest rates at 18%. If you start missing payments, if you start dragging out the loan, those interest costs are just going to pile up higher and higher and higher. And that's why you have to try to do anything you can to get ahead of this. Inflation has wiped out recent wage gains for almost all workers. Prices have climbed 8.2% last year, while average hourly earnings are up less than 5% in the same period. That has forced many families, especially those with lower incomes, to cut corners or take on extra debt. This is why inflation is so devastating, everyone. Look at this. Inflation's at 8.2%, but wages are only going up 5%. And what makes it even worse is inflation is actually much higher than 8%, more like double that, more like 16%. So in real terms, it's more like people's wages are falling 10%. This is why the standard of living for the middle class has been declining for the past 30 years. So it's forcing the middle class to cut corners, cut holidays, cut out luxuries, and have to work longer and longer and longer. So people, I know we're thinking, okay, what does this mean for you in simple terms? Well, this means that the banks are in trouble. They're going to have a lot of bad loans on their books, from auto loans to credit cards. And as inflation gets worse, that means interest rates are going to have to go higher, and it's just going to be more and more pain, and there's simply no way we can avoid it. So if you're in this situation, I really do feel for you. Try to figure out a way to start a side hustle to increase your income, pay off the highest interest rate debt first, and really sort out your budget. But everyone, what do you think? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.